Business. Any organization selling goods and services to attempt to earn profit. Enterprise. The legal classification of a business or its internal organizational and management framework. Sole proprietorship. The simplest and most common structure for a single owner. The business is not a separate legal entity, meaning all assets and liabilities are the personal responsibility of the owner. Partnership. Owned by two or more people, this structure is defined by an agreement covering management, profits, and liability. Limited partnership. LP has at least one general partner with unlimited liability and one or more limited partners with liability limited to their investment. Limited liability company. LLC, a hybrid structure offering the liability protection of a corporation with the tax flexibility of a partnership. Owners are called members. Corporation, Inc., a separate legal entity from its owners, providing the strongest protection from personal liability. It has more extensive record-keeping and regulatory requirements. C Corp, standard corporation taxed separately from its owners. Its profits can be taxed twice, once at the corporate level and again when dividends are paid to shareholders. S Corp, a special type designed to avoid double taxation by allowing profits and losses to pass through directly to owners' personal income. Quasi-public corporation is a company in the private sector that is supported by the government with a public mandate to provide a given service. Nonprofit institution is a group organized for purposes other than generating profit and in which no part of the organization's income is distributed to its members, directors, or officers. Unincorporated enterprise is a producer unit which is not incorporated as a legal entity separate from the owner. Fixed and other assets do not belong to the enterprises, but to their owners. The enterprises as such cannot engage in transactions with other economic units, nor can they enter into contractual relationships with other units, nor incur liabilities on their own behalf. In addition, their owners are personally liable, without limit, for any debts or obligations incurred in the course of production. Joint stock company, business with shareholders who are liable only to the extent of their shares and whose ownership is transferable. Characteristics. Shareholders, owned by multiple investors who purchase shares, representing a portion of the company. Liability. Shareholder liability is limited to the value of their shares, protecting their personal assets from company debts. Perpetual existence. The company continues to exist even as individual shareholders join or leave through the buying and selling of shares. Separate legal entity. A joint stock company is a legal entity separate from its owners, meaning it can own its own assets and incur its own debts. Examples. Registered company, the most common type, registered with state and local authorities. Chartered company, incorporated by a royal charter or other sovereign authority. Statutory company, created by a specific act of Parliament or other authorized body. Private limited companies, business structure where ownership is restricted to a small group of shareholders whose liability is limited to the amount they invested, and shares are not traded publicly. Public limited companies, type of limited liability company whose shares can be sold to the general public, often on a stock exchange, to raise capital. Franchises, business model where a person, franchisee, buys the right to operate a business under the established name and business plan of a larger company, franchisor. Agreement, a franchisee purchases the right to operate under the franchisor's brand and business model. Franchise fee, the franchisee pays an initial, often non-refundable, fee to the franchisor. Royalty fees, the franchisee pays ongoing fees, often a percentage of sales, for the right to continue using the brand and operating system. Support and control, the franchisor provides support, training, and a business plan, while also exercising some control to ensure brand standards are met. Workers' cooperatives, business owned and run by its employees, who share profits and have a say in the company's direction. Ownership and control, workers are the members of the cooperative and hold the majority of board seats. Decision-making, each worker-owner has an equal vote in the business's direction, adhering to a one worker, one vote principle. Profit sharing. Profits are distributed to worker members based on a formula that considers factors like job position, hours worked, and seniority. Benefits. Jobs tend to be longer term, offer better wages, and provide more skills training than similar conventional jobs. Community impact. Profits stay local, building community wealth and keeping workers connected to their communities. Limited liability partnership, a business structure that combines the flexibility of a traditional partnership with the limited liability of a corporation. Limited liability. Partners are not personally responsible for the debts and liabilities resulting from the professional malpractice or negligence of other partners. However, they are still responsible for their own actions and potentially for general business debts depending on the state. Tax benefits. As a pass-through entity, the LLP avoids corporate double taxation, meaning profits are taxed only at the individual partner level. Structural flexibility. LLPs offer flexibility in management and profit distribution, which can be tailored to the needs of the business through a partnership agreement. Separate legal entity. An LLP is a separate legal entity from its partners, meaning it can own property, enter into contracts, and is liable for its own debts. Commonly used by professionals, the structure is popular with professionals such as lawyers, accountants, and architects who need protection from the errors of their partners. Small business, privately owned corporation, partnership, or sole proprietorship that has fewer employees and less annual revenue than a regular-sized business. Size. Small businesses are generally defined by having fewer employees and less revenue than a typical large corporation. Ownership. They are privately owned, often as a sole proprietorship, partnership, LLC, or corporation. Niche. Specialized segment of a larger market, targeting a specific group of customers with tailored products, services, or content. Government support. Being classified as a small business often makes a company eligible for government support, preferential tax policies, and programs. Family-owned business. Commercial organization where control is held by 2 or more family members, who may also be involved in its day-to-day operations. Ownership and control. Family members hold a controlling ownership stake and influence the business's vision, objectives, and policies. Size and scope. While many are small, family-owned businesses can also be large companies like Cargill, Ford, or Chick-fil-A. Employment. Multiple generations of the same family may work in the business, each taking on different roles and responsibilities. Industry. Family-owned businesses operate in nearly every industry, from agriculture and retail to finance and technology. Trade. Buying and selling of goods on the market. Domestic trade, or internal trade, involves buying, selling, and exchanging goods and services strictly within a single country's borders, using its local currency, governed by domestic laws and benefiting from a common culture, all facilitated by the nation's transport systems, air, water, rail. Wholesale. A business model involving the sale of goods in large quantities at lower prices to other businesses, such as retailers, rather than to individual consumers. https://u2.b/j3qfgzdrr_q c equals qkig 7lz4_8ubbed. Sourcing and procurement. Wholesalers buy products in large volumes directly from manufacturers or other suppliers, leveraging economies of scale to get discounted per unit prices. Inventory management. They store these goods in warehouses and manage inventory, ensuring a steady supply to meet retailer demand. Sales and distribution. Wholesalers sell the products to retailers, often offering value-added services like transportation and order fulfillment. Sales are typically business-to-business, B2B, and involve terms like minimum order quantities, MOQs, and specific payment terms, e.g., net 30, net 60. Resale. Retailers then apply a markup and sell the products in smaller quantities directly to the end consumers at a higher price. Retail. Business of selling goods or services directly to individual consumers for their personal use, rather than for resale. Target audience. The primary customer is the individual consumer, B2C, business to consumer, not another business. Transaction size. Sales typically involve small quantities of goods. Pricing. Products are sold at a higher price, with a markup, than the wholesale price to cover operational costs, e.g., rent, staff, marketing, and generate profit. Sales channels. Retail occurs through various channels, including physical brick-and-mortar stores, department stores, supermarkets, specialty shops, e-commerce websites, mobile apps, and direct selling. Focus. A major emphasis is placed on the customer experience, brand awareness, and convenience to attract and retain a large volume of customers. International trade. Exchange of goods, services, and capital across national borders. Import trade. Process of purchasing goods and services from a foreign country for domestic use. Scarcity and resources. To obtain natural resources, raw materials, or manufactured goods that are not available or are more expensive to produce domestically. Cost effectiveness. To purchase goods that are cheaper to buy internationally than to produce at home, such as certain agricultural products or manufactured items. Consumer choice and quality. To provide consumers with a wider variety of high-quality products that might otherwise be unavailable. Economic growth. To acquire advanced technology and capital goods needed for industrial and economic development. Preventing inflation. To help keep prices down by increasing the supply of goods. Export trade. Exchange of goods and services across international borders, where a country sells its products to another country. Meet standards. Ensure products meet the quality and packaging standards of the destination country. Follow regulations. Understand and comply with your own country's export regulations, which may include obtaining licenses. Find business partners. Partner with reliable and trusted companies in the destination country. Prepare documentation. Gather the necessary paperwork, such as commercial invoices, packing lists, certificates of origin, and letters of credit. Goods. Physical, tangible items that are produced, sold, or traded. Physical products. Goods are physical items, like cars, food, or books, that have been produced and have a demand. Tangible assets. They are considered tangible because they have a physical presence that can be touched, held, or owned. For sale. Goods are a central part of commerce and are typically exchanged for money in a market. Distinguished from services. Goods are different from services, which are activities or assistance provided by others, such as a teacher or a barber. Services. Intangible actions or activities performed for another. Intangibility, inseparability, variability, and perishability differentiate services from goods. Personal and business services. Activities like a barber cutting hair, a mechanic fixing cars, or a restaurant providing a meal. Professional services. This includes a wide range of fields such as finance, insurance, telecommunications, and computer services. Public services. Services provided by the government, including public works, libraries, parks, and fire departments. The Appleton Public Library is an example of a local public service. Religious services. Formal gatherings for worship, which can include regular services, weddings, funerals, or other ceremonies. Software services. In systems architecture, a service is a reusable software function that can be accessed through a defined interface. Producers, individual or organization that creates goods or services to be sold in the market. Creating value. Producers take raw materials or intangible inputs, like knowledge or design plans, and turn them into finished products or services that have greater market value. Meeting demand. Their activities are guided by consumer demand. Producers decide what to produce, how much to produce, and at what price to offer their goods or services to maximize profit and stay competitive. Driving economic activity. Producers are essential for a functioning economy as their operations generate employment, facilitate trade, and contribute to a nation's gross domestic product, GDP. Consumer is a person who consumes a product or service. Customer is a person or organization that purchases goods/services. Differences. Customer is the person or entity who purchases a product or service, while a consumer is the individual or group who is the final end user of that product or service. Marketing to a customer might focus on price and deals, while marketing to a consumer would emphasize the product's quality, experience, and benefits. Commerce is buying and selling goods and services between individuals and businesses. Retail commerce, selling goods and services to end users, encompassing both traditional brick-and-mortar stores and online platforms like e-commerce. Store retailers, these include traditional brick-and-mortar stores, such as department stores and boutiques. Non-store retailers, this category includes all forms of selling that do not take place in a physical store, such as e-commerce websites, mail-order catalogs, and direct selling. Omnichannel sales. Retailers now use multiple sales channels, such as physical stores, websites, mobile apps, and social media, to reach customers. Unified experience. The goal is to ensure that the customer experience is seamless and consistent across all these channels, from the initial marketing message to the final purchase. Customer centricity. Retail commerce is increasingly focused on providing personalized experiences and convenience for the consumer. Technological integration. Modern retail commerce platforms are built to integrate with other systems like customer data platforms, CDPs, ERPs, and CRMS to provide a single source of truth and leverage data for better decision-making. AI and automation. Artificial intelligence is being used to power a wide range of functions, from personalized product recommendations and virtual try-ons to optimizing inventory and automating workflows. Wholesale commerce. Sale of goods in bulk at discounted prices to other businesses rather than the end consumer. Wholesalers profit buying in bulk at a lower price and selling with a markup. Retailers save money buying in bulk from wholesalers. Manufacturers can sell large volumes to a smaller number of wholesalers, streamlining. And online businesses can more easily compare prices and product offerings from various suppliers and automate administrative tasks. Business to business, B2B transactions are between companies, such as a wholesaler and a retailer. Bulk sales. Products are sold in large quantities, which is reflected in discounted pricing on a per-unit basis. Intermediary role. Wholesalers bridge the gap between manufacturers and retailers, allowing manufacturers to focus on production while retailers can stock their shelves. Supply chain link. They're a vital part of the supply chain, distributing products between business partners. Online platforms. The rise of wholesale e-commerce uses online platforms to facilitate these transactions, making it easier for businesses to find suppliers and place orders. E-commerce, buying and selling of goods and services over the internet. It allows businesses to sell directly to customers through websites, apps, or online marketplaces, offering benefits like lower operating costs and a global customer reach. Business to consumer. B2C. A business sells directly to an individual customer, e.g., buying a shirt from a brand's website. Target audience. The customer base consists of other businesses, organizations, government bodies, B2G, or institutions, not individual shoppers. Decision process. The buying process is often complex, involving multiple stakeholders, e.g., procurement teams, IT, finance, executives, and formal approvals. Sales cycle. Due to the complexity and high value of purchases, B2B sales cycles are typically much longer, sometimes lasting weeks or months, compared to quick, often impulse-driven B2C sales. Pricing and volume. Pricing is often customized based on volume, contract terms, and negotiation, with transactions involving large, bulk orders. Relationship focus. B2B success relies heavily on building and nurturing long-term, trust-based relationships and partnerships, ensuring reliability and consistent service. Business to business. B2B. A business sells products or services to another business, e.g., a software company selling to a large corporation. Consumer to consumer. C2C. Individuals sell items to each other, e.g., selling a used item on a marketplace. Third-party platform. A business-owned platform acts as an intermediary, connecting individual buyers and sellers. The platform owner may charge fees for listing items or for final transactions. Online marketplaces. Examples include auction sites like eBay, classifieds like Craigslist, and specialized marketplaces like Etsy. Beyond online platforms, the concept also extends to social media marketplaces like Facebook Marketplace and apps like Depop, as well as non-internet examples like flea markets and classified newspaper ads. Consumer to business, C2B, an individual offers their products or services to a business, e.g., a freelance graphic designer selling services to a company. Mobile commerce, m-commerce, e-commerce transactions conducted on a mobile device. Mobile shopping, purchasing products or services through a mobile device. This can include dedicated e-commerce apps, mobile-friendly websites, or social media platforms. Mobile payments, using mobile devices to make payments. This involves digital wallets like Apple Pay, Google Pay, and PayPal, peer-to-peer payment apps, and in-app purchase options. Mobile banking, managing financial accounts and performing banking tasks such as transferring funds, paying bills, and depositing checks directly from a mobile device. International commerce, exchange of goods, services, and capital across borders between countries. Exchange of goods and services, buying and selling products and services between countries. Capital flows, moving money for investments and other financial transactions across borders. Foreign direct investment, companies establishing operations in other countries. Intellectual property, licensing patents, trademarks, and other intellectual property internationally. Logistics and financing, services like cross-border transportation and trade financing. Business operations, core, daily activities a company performs to create value and generate profit. Production and supply chain, managing the flow of goods from raw materials to the finished product and delivering them to customers. Raw material sourcing, obtaining the necessary materials from suppliers. Manufacturing, transforming raw materials and components into finished goods. This can include creating semi-finished parts and assembly plants. Inventory management, tracking materials and finished products to ensure the right amount is available at the right time. Distribution, moving finished products from manufacturing centers to consumers through distribution centers and retailers. Logistics, the planning and management of the physical flow of goods, including transportation and warehousing. Information flow, communicating information and managing data across all stages of the chain. Marketing and sales, promoting and selling products or services. Marketing, comprehensive process of creating, communicating, delivering, and exchanging offerings that provide value to customers, clients, partners, and society, focusing on understanding audience needs, promoting products/services, and building lasting customer relationships to achieve business goals like increased awareness, leads, and sales. Classic 4PS marketing mix. Where customers find and buy it, distribution location. Promotion, creating awareness, generating interest, and persuading customers to purchase through various channels. Market research, systematically gathering, analyzing, and interpreting information about a market, target audience, and competitors to inform strategic business decisions. Informed decision-making, it replaces guesswork and assumptions with data-driven insights, leading to better outcomes. Customer centricity. It helps businesses understand customer preferences, behaviors, and pain points, allowing for the creation of products and services that better meet their needs. Competitive advantage. By analyzing competitors' strengths, weaknesses, and strategies, a business can identify gaps in the market and differentiate its offerings. Risk mitigation. Research helps identify potential threats, economic influences, and negative brand perceptions before they cause significant damage. Optimized strategies. It informs effective marketing campaigns, pricing decisions, product development, and overall business planning. Primary research. Data collected firsthand, tailored to specific research objectives. It provides in-depth, original insights. Secondary research. Leveraging existing data that has already been published by external sources. It's often faster and cheaper than primary research. Qualitative research. focuses on non-numerical data to explore motivations, opinions, and underlying behaviors, providing rich, descriptive insights. Quantitative research focuses on numerical data that can be measured and statistically analyzed to quantify problems and generalize results to a larger population. Advertising, paid promotion of products, services, ideas, or causes to a target audience through various media, print, digital, TV, radio, billboards, to influence perception, increase awareness, and drive specific actions, primarily sales, by broadcasting persuasive, controlled messages that highlight benefits and features. Content marketing, creating valuable content, blogs, videos, to attract an audience. Social media marketing, using platforms like Instagram, Facebook, etc., to build brand and engage customers. Email marketing, sending targeted messages to subscribers. SEO, search engine optimization, optimizing content to rank higher on search engines like Google. Influencer marketing, partnering with influencers to promote products. Inbound marketing, attracting customers with helpful content, contrasting with outbound, pushing messages out. Product marketing, focusing specifically on the launch and positioning of a product. Sales, activities of promoting, selling, and distributing products or services for money, acting as the core revenue generator by exchanging value for payment, involving understanding customer needs, providing solutions, and guiding them from interest to purchase. It's more than just a transaction. It's a process of building relationships, solving problems, and ensuring customer satisfaction to drive business growth and revenue. Prospecting, finding potential buyers. Engaging and educating, interacting with prospects, understanding their issues, and explaining how your offering helps. Negotiating and closing, finalizing the deal. Post-sale support, ensuring customer satisfaction after the purchase. Direct outreach, proactive strategy of personally contacting potential customers, clients, or partners with tailored messages to build relationships, generate leads, or offer specific services, rather than waiting for them to come to you. Cold calling, unsolicited outreach, usually by phone, to potential customers who haven't previously shown interest, aiming to introduce a product/service, generate interest, and qualify leads for sales. Product demonstrations, presentations showcasing a product's features, functions, and value to potential customers. Synergy. Ideally, marketing and sales work together, with marketing generating leads and sales converting them. Effective communication between the two departments is crucial for success, allowing them to share insights and improve performance. Financial management, handling accounting tasks and managing the company's money. Keep the company solvent by ensuring sufficient cash flow to cover day-to-day expenses and avoid bankruptcy. Maximize profitability by setting optimal prices and evaluating the potential profit of new products or services. Minimize costs through careful monitoring of spending and overhead reduction strategies. Ensure a good return on investment, ROI, for investors and shareholders. Manage and mitigate financial risks, ensuring compliance with all regulations to avoid fines. Capital budgeting, deciding which long-term investments or projects to pursue, e.g., building a new factory. Capital structure, determining how to fund the chosen investments, e.g., using a bank loan or seeking venture capital. Working capital management, ensuring day-to-day operations have sufficient cash flow and liquidity. Planning and budgeting, using historical and current financial data to set future targets, forecast performance, and create detailed budgets. Accounting and reporting, tracking, recording, and reconciling all monetary transactions to produce clear and accurate financial statements and reports for stakeholders and regulators. Cash management and forecasting, overseeing the flow of money in and out of the business to ensure enough cash is available for operations and growth opportunities. Investment and capital budgeting, deciding how to invest capital in profitable ventures and long-term assets, e.g., new equipment, market expansions, to add value to the business. Capital structure and financing, determining the optimal mix of debt and equity, loans versus selling stock, used to finance operations and expansion. Risk management, identifying potential financial threats, market risk, credit risk, liquidity risk, and implementing strategies to reduce exposure. Human resources, managing employer-related activities. The workforce. A narrower concept is the human capital within an organization, which includes the skills and knowledge of the employees. The department. HR is the department responsible for managing the company's employees and ensuring legal compliance. It is a strategic function that aims to align employee management with business goals. Recruitment and hiring, finding, screening, and interviewing candidates for open positions. Onboarding and training, integrating new employees into the company and providing ongoing training and development. Compensation and benefits, managing payroll, benefits programs, and setting compensation levels. Employee relations, handling disputes, enforcing policies, and fostering a positive work culture. Performance management, overseeing employee performance reviews and setting performance standards. Compliance, ensuring the organization adheres to labor laws and regulations. Customer service, ensuring customer satisfaction and loyalty. Assistance, providing help and advice to customers on their products or services. Problem solving, addressing customer concerns, complaints, and issues to find a resolution. Support, offering support before, during, and after a sale, which can include things like product recommendations or troubleshooting. Communication, interacting with customers in a helpful and empathetic way. Delivery, can be provided through various channels, including in-person, phone, email, social media, and self-service options like FAQs. Quality control, ensuring products meet specified quality standards. Inspects products and services. It involves examining items or services for defects or deviations from the desired quality standards. Monitors processes. It continuously monitors and adjusts processes to ensure the final output has the least possible variation from the standard. Identifies and corrects issues. It uses tools to find the root cause of problems, such as a fishbone diagram or a Pareto chart, and then corrects the underlying issues to prevent recurrence. Ensures consistency. It helps a business deliver a consistent product or service every time, which builds customer trust and loyalty. Business ethics, the moral principles and standards that guide behavior and decision-making in the business world. Business ethics build trust and credibility, reduces risk, boosts employee morale and retention, and attracts investors/customers. Honesty, being truthful and transparent in all dealings, avoiding misrepresentation or partial truths. Integrity, consistently adhering to strong moral principles and values, even under pressure. Fairness, treating all stakeholders impartially and equitably, avoiding the abuse of power or taking advantage of others' mistakes. Accountability, taking responsibility for one's decisions and actions and their impact on stakeholders and the community. Transparency, being open and clear about business practices and decision-making processes, building trust with all parties. Respect for laws, ensuring all business activities comply with relevant local, state, and federal laws and regulations. Responsibility, recognizing the impact of business activities on society and the environment, often connected to corporate social responsibility, CSR, initiatives. Leadership, setting a positive ethical example from the top to foster an organization-wide culture of ethical conduct. Environmental concern, actively working to minimize the business's environmental impact through sustainable practices and waste management. Business law, body of rules that governs commercial activities, including the formation and operation of companies, contracts, and intellectual property. Business formation, laws guiding the initial setup of a business, including choosing a legal structure such as a sole proprietorship, partnership, limited liability company, LLC, or corporation, and filing the necessary paperwork at the state and local levels. Choose a business structure. Decide on a legal structure like a sole proprietorship, partnership, limited liability company, LLC, or corporation, as each has different legal and tax implications. Register your business. Register your business with the appropriate government agencies. This typically involves filing a document like articles of organization for an LLC with the state's Department of Financial Institutions. Some business types may register with the Department of Revenue instead. Get an EIN. Obtain a Federal Employer Identification Number, EIN, from the IRS, which is needed for various business activities like opening a bank account and handling taxes. Obtain licenses and permits. Research and apply for any necessary federal, state, and local licenses and permits specific to your industry and location. Follow compliance laws. Be aware of ongoing legal requirements, such as BOI, beneficial ownership information, reporting under the Corporate Transparency Act. Contract law governs the creation and enforcement of agreements between parties. Legally binding contracts require specific elements like an offer, acceptance, consideration, something of value exchanged, and lawful intent. Offer. One party makes a promise to another. Acceptance. The other party agrees to the terms of the offer, which must be communicated. Consideration. Each party must provide something of value, such as money, goods, services, or a promise to do or not do something. Employment law governs the relationship between employers and employees, covering a wide range of topics like wages, safety, and discrimination. Wages and hours. The FLSA establishes a federal minimum wage, currently $7.25 per hour, and requires overtime pay at time and a half for hours worked over 40 in a week, though states may have higher minimum wages. Non-discrimination. Federal and state laws prohibit discrimination in all areas of employment based on protected characteristics such as race, color, religion, sex, national origin, age 40 and over, disability, and genetic information. Family and medical leave. The FMLA entitles eligible employees of covered employers to take unpaid, job-protected leave for specific family and medical reasons, such as the birth of a child or to care for a family member with a serious health condition. Workplace safety. The Occupational Safety and Health (OSH) Act requires employers to provide a workplace free from recognized hazards that are causing or are likely to cause death or serious physical harm. Employee rights. Other laws address issues like the rights of minors in the workplace, union organizing, and employee privacy. Employer obligations. Employers have obligations to comply with these laws, which include documenting employee performance and infractions, providing safe working conditions, and following legal procedures for hiring, firing, and promotions. Labor law mediates the relationship between workers, employers, unions, and the government, establishing fundamental rights and responsibilities in the workplace. Intellectual property, IP law, protects a business's intangible assets like inventions, brand names, and creative works. This includes laws for patents, trademarks, and copyrights. Patents protect technical inventions, giving the owner the exclusive right to make, use, or sell the invention for a set period, usually 20 years. Exclusive right. A patent provides a negative right, the right to exclude others from commercially exploiting the invention without consent. It does not necessarily give the holder the right to use or sell their own invention if it infringes on another, broader patent. Invention. An invention is a product or process that offers a new technical solution to a problem. To be patentable in the U.S., an invention must be new, novel, useful, and non-obvious. Intangible asset. In accounting, patents are considered intangible assets because they lack a physical form but provide economic benefits. The costs associated with obtaining and defending a patent can be capitalized and amortized over its useful life. USPTO, United States Patent and Trademark Office. Utility patents. These are the most common type, covering new and useful processes, machines, articles of manufacture, or compositions of matter, or any new improvements thereof. They protect how an invention works. Design patents. These protect a new, original, and ornamental design for an article of manufacture, essentially, what a product looks like, not its function. Plant patents. These are granted for the invention or discovery and asexual reproduction of a new and distinct variety of plant. Copyrights protect original artistic, literary, and other creative works, such as books, music, and software. They protect the expression of an idea, not the idea itself. Exclusive rights of copyright holders. Reproduce, to make copies of the work. Distribute, to distribute copies to the public. Perform, to perform the work publicly. Display, to display the work publicly. Create derivative works, to make new works based on the original, such as adapting a book into a movie. Key aspects of copyright. Automatic protection. Copyright exists automatically the moment a work is created and fixed in a tangible form. Registration. Registering the work with the U.S. Copyright Office is not required for protection, but strengthens legal standing in case of infringement. Duration. Copyright protection lasts for the life of the author plus 70 years. For works made for hire and anonymous or pseudonymous works, it is 95 years from publication or 120 years from creation, whichever is shorter. Limitations. Some uses of copyrighted works are permitted under certain conditions, such as fair use. Trademarks. Protect brands by guarding words, phrases, logos, and symbols that distinguish the goods or services of one party from those of others. They can last indefinitely as long as they are renewed and in active use. Identify and distinguish. It serves as a unique identifier for your business so customers can recognize your products or services in the marketplace. Protect brand identity. It provides exclusive rights to use the mark, preventing competitors from using a similar mark that could cause confusion. Build value. A strong and well-known trademark is a valuable asset for a business. Trade secrets. Protect confidential business information that provides a competitive edge, like formulas, strategies, or customer lists. Protection lasts as long as the information remains secret. Information can be a formula, pattern, compilation, program, device, method, technique, or process. Economic value derives its value from not being generally known or readily ascertainable by others. Competitive advantage gives a business an edge over competitors because they can't get the information through proper means. Reasonable measures. The owner must take reasonable efforts to keep it secret, which can include limiting employee and visitor access, using confidentiality agreements with employees and partners, marking information as confidential, implementing physical and technological restrictions. Tax law, federal, state, and local regulations governing how businesses are taxed and their obligations for withholding employee taxes. Individual income tax. Payer. Individuals pay this tax on income from wages, salaries, self-employment, and flow-through business profits. Rate structure. The U.S. uses a progressive tax system with 7 marginal tax rates ranging from 10% to 37% for the 2024 tax year, meaning rates increase as income increases. Taxable income. Based on an individual's total income after accounting for deductions, standard or itemized, and credits. Filing. Individuals typically use Form 1040 and may use Schedule C or K-1 to report business income. Other considerations. Self-employed individuals also pay self-employment taxes, Social Security, and Medicare at a rate of 15.3%. Corporate income tax. Payer. C corporations, which are considered separate legal and tax-paying entities from their owners, pay this tax on their profits. Most other business structures, S corporations, partnerships, sole proprietorships, are pass-through entities, and their business income is taxed at the owner's individual rates. Rate structure. The federal corporate income tax is a flat rate of 21%. Filing. Corporations file their taxes using Form 1120, U.S. Corporation Income Tax Return. Double taxation. Corporate profits are taxed at the corporate level and then again at the individual level when distributed to shareholders as dividends or realized as capital gains. State taxes. Most states, 44 plus D.C., also impose a corporate income tax, with rates varying significantly. Estimated taxes. Corporations generally must pay estimated taxes in quarterly installments. Employment taxes covered under Subtitle C. These include Social Security and Medicare taxes, part of the Federal Insurance Contributions Act, or FICA, and the Federal Unemployment Tax Act, FUTA. Federal income tax. This is based on an employee's earnings and information provided on Form W-4. The employer withholds and pays this tax on the employee's behalf. Federal Insurance Contributions Act, FICA, is made up of Social Security and Medicare taxes, which are split evenly between the employer and employee. Social Security. For 2025, the rate is 6.2% for both the employee and employer, totaling 12.4%. This tax only applies to wages up to the annual wage base limit, which is $176,100 for 2025. Medicare. The rate is 1.45% for both the employee and employer, totaling 2.9%. Unlike Social Security, there is no wage cap for this tax. Additional Medicare tax. High-earning employees must pay an additional 0.9% on wages over $200,000, which employers are responsible for withholding. The employer does not match this additional tax. Federal Unemployment Tax Act, FUTA. Employers alone pay this tax to fund unemployment compensation programs. Tax rate 6% of the first $7,000 each employee earns annually, up to a maximum of $420 per employee. Employer credits up to 5.4% credit for paying state unemployment taxes, reducing the FUTA rate to 0.6%. Filing annual Form 940 with quarterly deposits due the last day of the quarter's month. Exemptions. Employers who paid less than $1,500 to employees in any quarter of the previous 2 tax years, or didn't employ anyone for at least part of a day in 20 or more weeks during that time. FUTA taxes fund UI programs and benefits for eligible workers who have lost their jobs. It also covers a portion of extended unemployment benefits during high unemployment periods and provides a loan fund for states. State Unemployment Tax Act. SUTA. State unemployment taxes are typically paid only by the employer, though a few states require employee contributions as well. 2025 calendar year. Taxable wage base. The SUTA tax is only applied to the first $14,000 of each employee's annual wages. New employer rates. 3.05% for employers with a taxable payroll of less than $500,000. 3.25% for employers with a taxable payroll of $500,000 or greater. New construction employers have specific rates, generally between 2.5% and 2.7%. Experienced employer rates. Rates range from a minimum of 0% to a maximum of 12%, determined by the employer's reserve percentage, their history of unemployment claims. Employee contributions. Employees in Wisconsin do not pay SUTA tax. It is solely an employer-paid tax. State and local taxes. Depending on the location, state and local income taxes, state disability taxes, and workers' compensation premiums may also be included. Common types of state and local taxes. Individual and corporate income tax. Some states and localities levy a tax on the earnings of individuals and businesses. Sales tax. A percentage of the sales price of goods and services is taxed in most states and some municipalities. Property tax. Often paid to local governments, this tax is based on the assessed value of real estate. Personal property tax. Some jurisdictions tax the value of personal property, such as vehicles, boats, and business equipment. Estate and gift taxes. Subtitle B covers taxes on the transfer of wealth through estates or gifts that exceed a certain value threshold. Estate tax. A federal tax on the transfer of a person's property and assets, the gross estate, at their death. The executor of the estate is responsible for filing a return if the gross estate value exceeds the filing threshold. Gift tax. A federal tax on the transfer of money or property to another person during the donor's life for less than full value. It prevents individuals from avoiding the estate tax by giving away their assets before death. The tax is typically paid by the donor, not the recipient. Unified exemption. Both the estate and gift taxes share a single, unified lifetime exemption amount. The gift amount that exceeds the annual exclusion reduces the total lifetime exemption available at death. Annual gift tax exclusion. A set amount you can give to any one person in a calendar year without having to file a gift tax return or use up any of your lifetime exemption. The annual exclusion is $19,000 per recipient in 2025 and 2026. Married couples can gift split to effectively double this amount to $38,000 per recipient per year. Excise taxes addressed in subtitles D and E. These are taxes on specific goods, services, or activities, such as gasoline, alcohol, and tobacco. Generate revenue. Funds are often dedicated to specific trust funds, such as using gasoline taxes for highway maintenance. Discourage harmful behavior. Sin taxes. Higher taxes on products like tobacco, alcohol, and sugary drinks are intended to reduce consumption due to associated health and social costs. Charge user fees. Taxes on items like airline tickets or heavy highway vehicles help fund related public services and infrastructure, e.g., airports, roads. Capital gains taxes. These are federal taxes on profits from the sale of assets like stocks or real estate, with different rates for short-term versus long-term gains. Short-term capital gains tax. Short-term capital gains are profits from selling an asset you held for 1 year or less. These gains are taxed at your regular federal income tax rate, which, for 2025, can be as high as 37%. 2025 federal income tax brackets also apply to short-term capital gains. Single, 10% to 37%. Head of household, 10% to 37%. Married filing jointly, 10% to 37%. Married filing separately, 10% to 37%. Long-term capital gains tax. Long-term capital gains are profits from selling assets held for more than 1 year. The tax rates are 0%, 15%, or 20%, depending on your income. Calculating capital gains and tax liability. Basis. The cost basis is the original purchase price of an asset, plus any fees or commissions. Gain/loss. You calculate your capital gain or loss by subtracting the cost basis from the sale price. Netting. You can offset capital gains with capital losses. First, you net short-term gains against short-term losses and long-term gains against long-term losses. The net result is then used to determine your overall tax liability. Deduction. If your capital losses exceed your gains, you can deduct up to $3,000 of that loss against your ordinary income. Special rules/exemptions. Home sale exclusion. You may exclude up to $250,000 of capital gains from the sale of your primary residence, or $500,000 if married filing jointly, if you have owned and lived in the home for at least 2 of the last 5 years. Collectibles. Long-term capital gains on collectibles like art and coins are taxed at a higher maximum rate of 28%. High-income earners. A 3.8% net investment income tax, NIT, may apply to high-income taxpayers. Tax-advantaged accounts. Investments held in tax-advantaged accounts, such as 401(k)s or IRAs, are not subject to capital gains tax while in the account. Commercial law deals with the sale of goods, payments, and secured transactions, with the foundational component in the U.S. being the Uniform Commercial Code, UCC, which has been adopted in some form by all 50 states. Contract law deals with the formation, negotiation, and enforcement of agreements between parties. Offer and acceptance. There must be a clear offer by one party and an unequivocal acceptance of that offer by the other. This is often referred to as a meeting of the minds or mutual assent. Consideration. Each party must exchange something of value. This price for which the promise of the other is bought can be money, goods, services, or a promise to do, or not to do, something. Legal capacity. All parties involved must be legally competent to enter into an agreement. Minors, individuals with certain mental incapacities, or those under the influence of drugs or alcohol generally lack the capacity to form a binding contract. Lawful purpose. The purpose and terms of the contract must be legal and not violate public policy. An agreement to engage in a legal activity is void and unenforceable. Bilateral versus unilateral. A bilateral contract involves mutual promises, e.g., A promises to pay and B promises to work. A unilateral contract involves a promise by one party in exchange for a specific action by the other, e.g., a reward offer for a lost pet. Express versus implied. Express contracts have terms explicitly stated, either in writing or orally. Implied contracts are formed by the actions and conduct of the parties involved. Written versus oral. While most contracts do not need to be in writing to be enforceable, the statute of frauds requires certain types, such as contracts for the sale of land or agreements that cannot be performed within 1 year, to be documented. Damages. Monetary compensation for losses incurred due to the breach. Specific performance. A court order requiring the breaching party to fulfill the terms of their promise, typically used only when monetary damages are inadequate, e.g., in real estate transactions or for unique goods. Rescission, cancellation of the contract, restoring both parties to their pre-contractual positions. Common law. This judge-made law derives from past court decisions and governs contracts for services, real estate, and employment. Based on precedent, judges make rulings that become binding precedent for future cases with similar facts. Stare decisis. This principle requires courts to follow established legal principles and prior decisions. Adaptable. Common law can evolve as courts address new situations not covered by existing statutes. Higher courts can also overrule prior decisions they deem bad law. Adversarial. The system involves two opposing parties presenting their case to a neutral judge, rather than an inquisitorial system. Case law. The term case law is often used interchangeably with common law because it relies heavily on the records of past cases. Statutory law. The most significant statute is the Uniform Commercial Code, UCC, which standardizes laws for commercial transactions involving the sale of goods across all 50 states. Written form. Statutory laws are written down, unlike common law, which is based on court decisions. Legislative authority. They're created by elected representatives, not by judges. Hierarchical structure. Laws are often organized into codes, which group statutes by subject for easier reference. Constitutionality. All statutes must comply with the U.S. Constitution, otherwise they can be overturned by the courts. Public statutes. Apply to the general public, e.g., traffic laws. Private statutes. Apply to specific individuals or groups, e.g., immigration matters. Proposal. A bill is introduced in a legislative body by a member. Consideration. The bill goes through a process of committee discussions, hearings, debates, and revisions. Voting. Both chambers of the legislature vote on the bill. Approval. If passed, the bill is sent to the executive branch, the president at the federal level, or the governor at the state level, to be signed into law. Veto override. The executive can veto the bill, but the legislature can override the veto with a supermajority vote, depending on the jurisdiction. Sales and leases. Governs the sale and leasing of goods, largely standardized in the U.S. by the Uniform Commercial Code, UCC. Article 2 of the UCC deals with the sale of goods. Article 2A of the UCC addresses the leasing of goods. Secured transactions. Regulates agreements where a lender takes a security interest, collateral, in property to secure a loan. Debtor. The borrower or party who owes the debt. Secured party. The creditor or lender who is owed the debt. Collateral. The specific property that the debtor pledges as security for the loan. Security interest. The lender's legal right to the collateral, which is created by the agreement between the debtor and secured party. Negotiable instruments. Covers documents that represent money, such as checks and promissory notes. Notes. Promises to pay. Promissory notes. A written promise by one party, the maker, to pay a specific sum of money to another party, the payee, at a certain date. Certificates of deposit. CDs, an acknowledgement by a bank that a sum of money has been received with a promise to repay the sum, plus interest, at a specified time. Drafts. Orders to pay. Checks. A common type of draft payable on demand and drawn on a bank. This category includes personal checks, cashier's checks, and teller's checks. Bills of exchange. An unconditional order in writing requiring the person to whom it is addressed to pay a sum certain in money to a specified person or to bearer. Money orders. Similar to checks, these are usually issued by financial institutions or other entities and guarantee payment of the specified amount. Traveler's checks. Instruments requiring a countersignature. Writing and signed. The instrument must be in a tangible form and signed by the maker for a note or drawer for a draft. Unconditional promise or order. The promise or order to pay must be clear and not dependent on any other external agreement or condition. Fixed amount of money. The specific amount of money to be paid must be clearly stated, though interest or other charges may be included. Payable on demand or at a definite time. The payment date must be specified as either immediately payable when presented or at a precise, determinable future date. Payable to order or bearer. The instrument must explicitly state that it is payable to an identified person or their order, or to the bearer, whoever possesses it. Checks are an exception and may omit these words. Banking and finance law. Overseas lending, credit, and financial market regulations. Federal. Key federal agencies include the Federal Reserve, the Federal Deposit Insurance Corporation, FDIC, the Office of the Comptroller of the Currency, OCC, and the Consumer Financial Protection Bureau, CFPB. State. State agencies are responsible for licensing and regulating non-bank financial service providers and have a large role in areas like insurance. Lending and credit. This includes laws governing mortgages, credit cards, and other loans, like the Truth in Lending Act, TILA and the Credit Card Accountability Responsibility and Disclosure Act, CARD Act. These laws ensure fair terms and proper disclosures to consumers. Financial institutions. The law governs the formation, operation, and liquidation of banks, credit unions, and other financial institutions. It also covers structural changes like mergers and acquisitions. Financial markets. This encompasses regulations for securities markets, derivatives, and other financial products to ensure stability and fair practices. Consumer protection. A major focus is on protecting consumers from unfair, deceptive, or abusive practices by financial institutions. The Consumer Financial Protection Bureau, CFPB, was created specifically to handle this role. Consumer protection encompasses laws like the Truth in Lending Act and the Fair Debt Collection Practices Act, which protect consumers from unfair or fraudulent practices. False advertising and marketing, prohibiting businesses from making untrue or misleading claims about products, prices, or services. Product safety, ensuring products are safe for use and requiring manufacturers to issue warnings or recalls for hazardous items. Financial products and services, regulating areas like credit cards, loans, mortgages, and debt collection to prevent predatory lending and abusive practices. Warranties and contracts, governing the terms of warranties and service contracts and providing consumers with a right to redress, repairs, replacements, or refunds when products are defective. Privacy and data protection, protecting consumer data and privacy in an increasingly online world, including rules around online tracking and data breaches. International trade law addresses the legal aspects of commerce between different countries, utilizing conventions and treaties like those facilitated by the World Trade Organization, WTO. Governing bodies and agreements. The World Trade Organization, WTO, is the primary international organization that oversees multilateral trade agreements, which are the successor to the General Agreement on Tariffs and Trade, GATT. Other agreements exist at regional or bilateral levels. Regulation of trade. This area of law regulates the trade of goods, services, and intellectual property between countries, aiming to ensure fair and orderly trade practices. Key principles. A core principle is non-discrimination, meaning imported goods should be treated no less favorably than like domestic products. Dispute resolution. International trade law includes mechanisms for resolving disputes that arise between member countries regarding trade rules and agreements. Domestic laws. Lawyers in this field also apply national laws to international trade transactions, such as the U.S. Trade Act of 1974, which addresses trade relief and enforcement of U.S. rights under trade agreements. Specialized areas. The law covers a wide range of specialized issues, including subsidies, technical standards, food safety regulations, and intellectual property rights. Real estate law covers the legalities of buying, selling, and leasing commercial property and land use regulations. Transactions. the legal framework for buying, selling, and leasing residential and commercial properties, including contract negotiation and closing processes. Ownership and rights, laws that define property rights, including titles and the limitations on those rights, such as through zoning or homeowner association rules. Landlord-tenant law, legal rules that govern the relationship between landlords and tenants, covering leases, rent payments, and eviction procedures. Land use and zoning, regulations that control how land can be used, which can include zoning laws, environmental protection, and restrictions on what landowners can do with their property. Financing and securities, laws related to mortgages, real estate finance, and the sale of real estate securities. Disputes, the resolution of conflicts such as construction disputes, claims against property rights, and foreclosures. Economics, applied field of economics that uses economic theory and quantitative methods to analyze financial, organizational, market-related, and environmental issues faced by corporations. Demand and supply analysis, study of how buyers and sellers' willingness to purchase and provide goods or services interact to determine market prices and quantities. It is a core concept in economics that uses the law of demand. As price goes up, quantity demanded goes down, and the law of supply, as price goes up, quantity supplied goes up, to find the market equilibrium, where quantity demanded equals quantity supplied. Demand, quantity of a good or service that consumers are willing and able to purchase at various prices during a specific period. Law of demand, an inverse relationship exists between price and quantity demanded. When the price of a good falls, the quantity demanded increases, and vice versa. Demand curve, a downward sloping line on a graph, representing the relationship between price and quantity demanded. Factors that shift demand. Shifters, changes in factors other than price, cause the entire demand curve to shift. Consumer income. Tastes and preferences. Price of related goods, substitutes and complements. Consumer expectations. Population and its distribution. Weather. Supply, the quantity of a good or service that producers are willing and able to offer for sale at various prices during a specific period. Law of supply, a direct relationship exists between price and quantity supplied. When the price of a good rises, the quantity supplied increases, and vice versa. Supply curve, an upward sloping line on a graph, representing the relationship between price and quantity supplied. Factors that shift supply, changes in factors other than price, cause the entire supply curve to shift. Price of production factors, e.g., labor, materials. Technology. Taxes and government regulations. Number of sellers in the market. Natural disasters or weather conditions. Equilibrium, the point where the demand curve and the supply curve intersect. At this point, the quantity demanded is equal to the quantity supplied. Equilibrium price, the price at which the market clears with no surplus or shortage. Surplus occurs when the quantity supplied is greater than the quantity demanded, leading to downward pressure on prices. Shortage occurs when the quantity demanded is greater than the quantity supplied, leading to upward pressure on prices. Production and cost analysis, optimizing the production process, managing costs, and improving efficiency. Production function, maximum output achievable from a given combination of inputs. X is output, K is capital, and L is labor. X equals F, KL. Diminishing marginal returns. Adding more of one variable input to a fixed input will eventually lead to smaller increases in output. Increasing marginal returns. Initially, adding more input, e.g. workers, leads to a more significant increase in output because new workers complement the existing resources and specialization takes place. Diminishing marginal returns. After a certain point, output continues to increase, but at a decreasing rate, as the variable input becomes less efficient due to the fixed input. Negative marginal returns. If too much of the variable input is added, total output can actually decrease. For instance, if workers are so crowded they can't work effectively. Fixed costs. Expenses that do not change with the level of output, such as rent or insurance. Average fixed costs equals total fixed costs divided by #/units produced. Variable costs, expenses that change in direct proportion to output, like raw materials or hourly wages. Total variable cost equals variable cost slash unit times total number of units sold. Raw materials, the direct materials needed to manufacture a product. Direct labor, wages paid to workers directly involved in production. Production supplies, consumables used in the manufacturing process. Commissions, payments to salespeople that are tied to sales volume. Packaging, the cost of materials used to package finished goods. Distribution, shipping and freight costs to get products to customers. Transaction fees, fees for processing payments such as credit card fees. Total costs, the sum of fixed and variable costs. Explicit costs, direct, out-of-pocket payments for resources like wages and materials. Labor, wages and salaries paid to employees. Rent, payments for office or factory space. Materials, the cost of raw materials used to produce a product. Utilities, bills for electricity, water, and gas. Advertising, money spent on marketing and promotion. Equipment, the purchase of new machinery or the cost of repairs on existing equipment. Taxes, payments made to the government. Direct payment, they involve a direct cash outlay. Measurable, they have a clear, quantifiable monetary value. Recorded, they are recorded in a company's accounting records and on financial statements. Receipts, you can typically get a receipt or invoice for an explicit cost. Accounting profit, explicit costs are subtracted from total revenue to calculate accounting profit. Implicit costs, the opportunity cost of using the firm's own resources, such as the owner's time. Opportunity cost, implicit costs represent the value of the next best alternative that was not chosen. Non-monetary, they do not involve a direct cash payment, which is why they are not reflected in financial statements. Example, owner's salary. If a business owner works for their company, the salary they could have earned at another job is an implicit cost. Example, using owned property. If a business uses a building it owns, the rent it could have charged a tenant is an implicit cost. Example, owner's capital. The interest or returns an owner could have earned by investing their capital elsewhere is an implicit cost. Importance. Implicit costs are crucial for calculating economic profit, total revenue minus both explicit and implicit costs, and making informed business decisions. Ignoring them can lead to an inaccurate assessment of a company's true financial performance. Marginal cost, the additional cost incurred by producing one more unit of output. Marginal cost equals change in total cost slash change in quantity. Profit maximization. Companies can maximize profits by producing up to the point where marginal cost equals marginal revenue. Mr. equals MC. Marginal revenue equals marginal cost. This is typically achieved through strategies like adjusting prices, optimizing inventory, and streamlining operations. Production decisions. It helps businesses decide whether to increase or decrease production. If marginal revenue is greater than marginal cost, increasing production is profitable. Long term, these are strategic decisions about the industry, products, and technology to use, and plant size. They involve committing to certain costs and are rarely changed. Short term, these are operational decisions about how much to produce, quantity, Q given the long-term commitments. The firm can adjust short-term costs by changing the quantity of variable inputs. Economies of scale. When a company produces more units at a lower cost, it experiences economies of scale, which lowers the marginal cost. Decreased average cost. As a company produces more, the average cost of each unit goes down. Bulk buying. Purchasing larger quantities of supplies often leads to a lower price per unit. Technological efficiency. Larger companies can invest in more advanced machinery and automation, which can increase efficiency. Spreading fixed costs. Costs like rent, advertising, and administrative salaries are spread across a larger number of units, lowering the per unit cost. Types. Economies of scale can be internal, achieved through a firm's own actions, or external, gained from industry-wide factors like a skilled labor pool. Diseconomies of scale. If a company becomes too large, it can experience a rise in average costs due to inefficiencies like poor communication and management complexity. Diseconomies of scale. When a company's costs per unit increase as it produces more, it experiences diseconomies of scale, leading to higher marginal costs. Organizational complexity. As a company grows, it can become difficult to manage, leading to communication breakdowns, coordination issues, and bureaucracy. Reduced employee motivation. Workers may feel less connected and motivated in a very large organization, which can decrease productivity and efficiency. Operational inefficiencies. The production process can become less efficient, leading to higher marginal costs for each additional unit of output. Resource constraints. Growth can lead to shortages or higher prices for necessary resources, increasing costs. External factors. An external factor like high traffic congestion in a location can increase transportation costs and lead to delays, impacting unit costs. Pricing strategies. Developing competitive pricing policies based on market structures, e.g., perfect competition, monopoly, costs, and profit objectives. Cost plus. Add a markup to production or acquisition costs. Competitor-based. Set prices based on competitors' prices. Value-based. Set prices based on perceived customer value. Penetration. Set lower prices than competitors to attract buyers and build brand loyalty. Price skimming. Set a high price initially and lower it over time. Capital management and investment analysis. Planning and controlling capital expenditures and making effective investment decisions. Working capital management. This focuses on a company's short-term assets and liabilities to ensure it has enough liquidity for daily operations. Key aspects include managing cash flow, accounts receivable, accounts payable, and inventory. Long-term capital management. This involves strategic decisions related to the company's capital structure, its mix of debt and equity financing, and long-term investments, such as acquiring assets or expanding operations. Fundamental analysis. This method evaluates a security's intrinsic value by examining underlying financial, economic, and qualitative factors, such as a company's financial statements and management. Technical analysis. This approach uses statistical trends from historical market data, such as price movements and trading volume, to identify trading opportunities and predict future price trends. Top-down analysis. This begins with analyzing broad economic and market trends before narrowing down to specific sectors and individual investments. Bottom-up analysis. This focuses on assessing individual securities based on their fundamentals, regardless of macroeconomic trends. Resource allocation. Investment analysis helps a company identify the most viable and profitable long-term projects to invest in, while capital management ensures the company has the financial resources to fund those projects. Risk and return. Capital management seeks to optimize the balance between risk and return at a strategic level, while investment analysis provides the tools to assess the risk and return of specific opportunities. Decision-making. Investment analysis informs the decisions made during capital management. For example, the findings from an investment analysis of a potential new facility would inform a company's capital budgeting decision. Profit management. Implementing strategies to maximize profitability through cost control and revenue management. Revenue and expense analysis. A fundamental part of profit management is tracking and analyzing both incoming cash, revenue, and outgoing cash, expenses. Tools like the profit and loss (P&L) statement provide a snapshot of financial performance to guide this process. Cost control. This involves identifying and minimizing costs, even seemingly small ones, that can impact profit margins. This can include reducing costs related to production, operations, and business processes. Pricing strategy. Profit management often requires an intelligent approach to pricing that considers both the customer's value perception and the operational costs of delivering the product or service. Channel and customer profitability. Analyzing the profitability of different sales channels, products, and customers is crucial. This helps in directing resources and efforts towards the most profitable areas. Profit maximization. This is a core objective, which involves finding the optimal point where producing one more unit of a good or service generates revenue equal to its marginal cost. Financial health and planning. By providing a deeper understanding of a company's real financial status, profit management helps with financial planning, forecasting, and ensuring long-term sustainability. It allows businesses to reinvest in operations and expand offerings. Risk analysis and forecasting, using economic indicators and statistical analysis to predict future market trends and manage associated risks. Risk analysis. Risk identification, detecting potential vulnerabilities and threats. Quantitative assessment, measuring the potential financial and other impacts using analytical tools and models. Mitigation planning, developing strategies to minimize the likelihood or impact of risks. Market risk, potential losses from market price fluctuations, such as stock market shifts or changes in interest rates. Credit risk, the risk of a borrower defaulting on a loan. Operational risk, risks related to a company's day-to-day operations. Liquidity risk, the risk of a company not being able to meet its short-term obligations. Forecasting, process of using past and present data to project future business performance, trends, and financial outcomes. Integration. These are core components of financial planning and analysis, FP&A, a function that supports corporate decisions through analysis of financial and operational data. Tools. Organizations use software tools and advanced analytics, including quantitative models, to automate risk assessments and build detailed financial models and forecasts. Outcome. A proactive approach that allows companies to better manage risks and capitalize on opportunities, rather than simply reacting to past events. Organizational and managerial issues, applying economic principles to internal management, human resources, and organizational structure to achieve the best outcomes for the company. Poor communication. A lack of transparency can lead to a negative climate, reduced trust, and lower employee engagement. High employee turnover. This involves employees leaving the company frequently, which requires constant hiring and training of new staff. Low productivity. This occurs when individuals or teams cannot complete tasks efficiently or on schedule. Negative workplace culture. This can stem from poor communication, lack of recognition, or other factors that harm employee morale and collaboration. Lack of innovation. An organization's structure, culture, or management may not support the development of new ideas and processes. Ineffective leadership. Leaders may fail to provide clear direction, motivate employees, or manage resources effectively. Business marketing. Process of promoting and selling products or services to other companies or organizations, rather than individual consumers. Builds awareness. Helps more businesses learn about your company and what it offers. Drives sales, generates leads, and encourages purchases. Increases retention, fosters long-term relationships with customers. Informed strategy, market analysis helps companies understand their audience and competitors. The 4Ps, a classic framework for developing a marketing strategy. Product, the goods or services being offered. Price, how much the product costs. Place, where and how the product is distributed. Promotion, how the product is advertised and sold. Digital marketing. Paid online advertising on platforms like Facebook, Instagram, or LinkedIn. Sponsoring podcasts or partnering with influencers. Pay-per-click, PPC, advertising. Traditional marketing. Print ads. Business cards, brochures, and newsletters, known as marketing collateral. Signage and storefront branding. Content marketing, creating and sharing valuable content, like social media posts, blogs, or videos, to attract and retain a clearly defined audience. Business advertising, paid marketing activity to promote products or services, raise awareness, and drive sales through various channels like digital platforms, social media, print, and broadcast. Digital advertising includes search engine ads, social media ads on platforms like Facebook, Instagram, and LinkedIn, and retargeting, which shows ads to people who have previously interacted with your business. Content marketing. Create engaging content, like informative blog posts or videos that answer customer questions to attract and build trust with an audience over time. Traditional advertising includes print ads in newspapers or magazines, radio commercials, television ads, and out-of-home advertising like billboards. Direct mail, sending promotional materials directly to potential customers' mailboxes. Local listings, register your business on local directories like Google My Business. Free advertising, utilize platforms like Facebook Marketplace or participate in Facebook groups that allow business promotions. Business administration, practice of managing the operations and resources of a business or organization to achieve its goals efficiently and effectively. Functions. Planning, process of setting goals and outlining strategies, including market analysis, financial forecasts, and operational details to achieve them. Define your business and mission. Clarify what your business does, the problem it solves, and your vision for the future. Conduct market research. Identify your target audience and analyze your competition to understand the market landscape. Develop your strategies. Create clear marketing and sales strategies to reach your customers and define your competitive advantage. Outline your organization. Describe your company's management and organizational structure. Create financial projections. Develop detailed financial forecasts, including startup costs, revenue projections, and cash flow statements. Write the plan. Organize all this information into a cohesive document. You can use a traditional, detailed format or a more concise, lean startup format. Refine and update. A business plan is a living document. Review and update it regularly to reflect your business's progress and changes in the market. Organizing. Developing an organizational structure and coordinating the necessary human, financial, physical, and informational resources to effectively achieve the company's objectives. Division of labor. The total work is divided into specific, specialized jobs or tasks to increase efficiency and productivity. Departmentalization. Similar jobs or tasks are grouped into meaningful units, such as departments, e.g., marketing, finance, operations, product lines, or geographical regions. Establishing a hierarchy/chain of command. Formal reporting relationships are established, making clear who reports to whom and defining levels of authority and responsibility within the organization. Delegation of authority. Managers assign authority and responsibility to subordinates, allowing them to make decisions and carry out tasks without constant oversight. Resource allocation. Ensuring all departments and individuals have the necessary resources, people, equipment, money, to perform their assigned activities effectively. Coordination. Managers ensure all departments and individuals work together harmoniously, aligning individual goals with overall business objectives to prevent conflict and duplication of effort. Leading. Chief Executive Officer, CEO, directs operations and overall business strategy. Operations Manager oversees the day-to-day running of the business. Financial Manager directs financial activities and helps the business make sound investment decisions. Human Resources Manager directs recruitment, employee relations, and training programs. Management Analyst recommends ways to improve an organization's efficiency and performance. Provide strategic direction and vision. Leaders create a vision for success, develop mission statements, and set strategic goals for the organization. Foster productivity and efficiency. Administrators manage resources, operations, and people to ensure goals are met efficiently and effectively. Mentor and inspire employees. Effective leaders inspire motivation and a sense of purpose among staff, which helps shape a positive company culture and nurture high performance. Make critical decisions. Leaders assess situations and make firm yet flexible decisions regarding everything from optimizing employee strengths to managing workloads and adapting to change. Ensure ethical practices. Strong leadership incorporates ethics and social responsibility into decision-making, which can boost a company's reputation and employee satisfaction. Coordinating. Process of integrating a company's activities, managing daily operations, and providing support to ensure organizational goals are met efficiently. Interdepartmental liaison, facilitating communication and collaboration between different departments, e.g., sales, marketing, finance, HR, to ensure a unified approach towards common goals. Project and schedule management, coordinating project timelines and deliverables, creating and managing schedules, and tracking progress to ensure deadlines are met. Administrative support, providing high-level administrative support to management and various departments, which may include managing calendars, organizing travel, preparing presentations, and maintaining accurate records. Budget oversight, assisting with budget management, tracking expenses, processing invoices, and planning for future financial needs. Process improvement, documenting existing procedures and developing initiatives to improve operational efficiency and workflow. Point of contact, serving as a primary point of contact for internal inquiries, clients, vendors, and external partners. Controlling. Establish standards, setting clear, specific, and measurable performance goals or benchmarks, e.g., increase sales by 10%. Measure actual performance, collecting data to track progress and results, e.g., generating sales reports. Compare performance with standards, analyzing any deviations or variances between actual results and the set standards. Take corrective action, implementing changes to resolve issues and bring performance back in line with the planned objectives, or revising the standards if necessary. Skills. Leadership. Strategic thinking, the ability to develop and implement long-term plans to achieve organizational goals. Vision, the capacity to see the big picture, anticipate market trends, and identify new opportunities. Motivation, inspiring and motivating others to perform at their best. Emotional intelligence, understanding and managing one's own emotions and those of others through self-awareness, empathy, and strong social skills. Adaptability, remaining flexible and open to new ideas and approaches in a changing business landscape. Communication, inspiring and persuasive communication to bring people along on a journey and foster commitment. Management. Organization, creating structure and clear processes to ensure smooth project and task execution. Time management, prioritizing tasks and managing schedules effectively to meet deadlines. Delegation, assigning the right tasks to the right people to empower them and achieve results. Problem solving, identifying and troubleshooting issues to find practical solutions. Decision making, making sound and timely choices, sometimes under pressure. Communication, clearly conveying expectations, providing feedback, and listening to others. Strategic thinking and problem solving. Big picture vision, aligning daily decisions and actions with overarching organizational goals, values, and long-term objectives. Anticipation and adaptability, anticipating threats, identifying opportunities, and adjusting strategies in response to market changes and complexities. Informed decision-making, using a framework to assess risks and weigh competing priorities to make sound, data-informed choices. Innovation, fostering a culture of curiosity and challenging the status quo to explore new possibilities and creative solutions. Communication. Verbal communication, articulating ideas clearly and concisely, both in formal presentations and everyday conversations. Written communication, conveying information effectively through emails, reports, and other written documents. Nonverbal communication, understanding and utilizing body language, facial expressions, eye contact, and tone of voice to convey a positive and professional image. Public speaking, effectively presenting information to groups and adapting messages to different audiences. Interpersonal skills. Active listening, concentrating on the speaker, asking clarifying questions, and responding thoughtfully to fully understand their message, which builds trust and reduces misunderstandings. Empathy, understanding and sharing the feelings of others, which is crucial for building strong relationships and a positive work environment. Conflict resolution, approaching difficult conversations with an open mind, focusing on understanding others' perspectives to find common ground and resolve issues peacefully. Teamwork, Collaborating effectively with others to achieve shared goals, which requires strong communication and mutual respect. Leadership, motivating and guiding team members while being self-aware and showing compassion and empathy to foster a productive and supportive atmosphere. Emotional intelligence, the ability to manage your own emotions and understand the emotions of others, which helps in navigating interpersonal dynamics and reducing workplace conflict. Data analysis and decision-making. Data gathering and cleaning. Collect relevant data from sources like customer feedback, sales reports, and market trends. Clean and organize the data to ensure accuracy and consistency. Data analysis. Use various techniques to analyze the data and find patterns, relationships, and insights. This